Hello, everyone, and welcome to the weekly update, Crypto for Financial Planners, for financial professionals, whether you're a financial advisor, a CPA, a banker, attorney, someone who helps someone else with their money. This update on what's happening in crypto, or what happened last week in crypto, I guess, is for you. So what I'm going to start with first is something I promised to go into the previous week, which I really didn't, was the first ever comprehensive framework for responsible development in digital assets, released by the White House, by the current Biden administration. And this is a follow-up to their executive order that came out earlier in the year to basically, my understanding is go through some of the directions they are looking to go. So read through this a couple times and wanted to point out a few things. One, it's obviously very skewed towards investor protection. It's very skewed towards the government kind of creating their own systems and not relying on this decentralized system, whether Bitcoin or Ethereum or anything else, kind of the government trying to create their own, even though when we go reading through here, we find references to statements like promote innovation by kickstarting private sector research and development, help cutting-edge U.S. firms find footholds in global markets. That's a nice thing. That's actually something the U.S. has been doing for decades and decades and a couple of centuries, is trying to promote research, development, and innovation. And that's exactly what crypto and decentralized finance and blockchain is it is innovation. So the idea is right that the White House, the administration, the government should be trying to promote innovation by trying to build up some of these technologies that are being built. But then they want to mitigate the downside risk, which I'm all for mitigating downside risk. But what we have to understand is with any innovation, whether it's investment in the innovation or what it might be, there is going to be risk, and you can't 100% limit that. You can't make it zero, because without the risk, there is no reward, there's no return, and there's no innovation without any sort of risk. And of course, we've seen where lately they've tried to talk about standards regarding cryptocurrency mining, and quite a bit of that seems to have been driven by political action committees or driven by some other groups with an axe to grind against those that are mining Bitcoin and using energy to do so. So we will go ahead and move forward here. Now, this is where we talk about protecting consumers, investors, businesses. I am all for protecting consumers, investors, and businesses. And one of the reasons why is we need investors to stay safe. Every time there's a hack or an exploit, every time people lose their money because some exchange acted incorrectly, didn't manage their risk, people thought their money was insured, something like that, we're closer and closer to being even more regulated to the point that crypto is no longer useful, is no longer meant, or is no longer useful for the purposes it was meant for. And that's definitely not the direction we want to go. So unfortunately, it encourages regulators like the SEC and the CFTC to aggressively pursue investigations and enforcement actions. The problem is they're pursuing investigations and enforcement actions against unlawful practices. The law of the land right now is currently laws that date back to the 1930s, which don't necessarily address what is currently happening. And so in the SEC and the CFTC, which we'll get to soon, having these enforcement actions, they're enforcing laws that were put about barely after the telephone was invented and used widely. And now we have this new technology, and they're trying to address or enforce laws that were put in place that many years ago. It actually does not make that much sense. Then we start to add to this the Consumer Financial Protection Bureau and the FTC redoubling their efforts. I am all for this. I do not like the idea that there are people who are promoting cryptocurrencies, promoting investment in them, who are not at all licensed advisors. And I'm not talking about people who are advertising for companies. If you're advertising for people to use a company like crypto.com or like FTX, you are not in any way, shape, or form, in my opinion, endorsing, telling people they should go invest. Just like Charles Schwab, Fidelity, they all have actors, they all have celebrities that endorse or do advertisements for their companies, for their custody, for their exchanges. And that doesn't mean that if I go and put all my money into some sort of 3x leveraged inverse ETF, that Schwab or that particular celebrity endorser should be liable. What I'm talking about is the people who are on YouTube, Twitter, wherever, that are actually trying to tell people what they should do with their money, that are not licensed advisors. There should absolutely be more issues or more help from the government with regard to consumer complaints. And it'd be really nice if more of those complaints, and there are easier ways to get those complaints out there. Again, it shouldn't just be against advertisers. That's very different than telling people what they should do with their money. It would be really nice. They encourage agencies to issue guidance and rules, which is funny because right back up here, this says aggressively pursue enforcement actions. And then here, they need to issue guidance and rules. Well, you kind of either do one or the other. You either say, here's our guidance and here's our new rules to address it, or we're just going to enforce the old laws. But it seems like what some of these agencies are doing is both. And that really confuses everyone. In addition, they're encouraged to share data on consumer complaints. Well, it's a really good platform for sharing data and making things transparent is this public blockchain thing. It'd be a really cool place to share data on consumer complaints. And the government doesn't even have to create its own whole new database. It's already there. So now we talk about the White House talks about promoting access to safe, affordable financial services, and they point out correctly, 7 million Americans have no bank account, 24 million rely on costly non-bank services like check cashing. This is exactly why we as financial professionals need to be helping out clients. One, if we go back up here, we definitely, obviously don't want to be aggressively pursue. We don't want to be part of the investigation, but most importantly, there are so many people that actually really, really need this because banks are expensive. Check cashing services, which replace banks for a lot of people, are even more expensive. And then if you go to cross-border payments or something, all the people that have come here from other countries and try to send money back to their family in another country, that is all very expensive. That's exactly what the digital economy is here for. Of course, then the Fed says we've created our own system, this instantaneous system that is planned for 2023, but of course it's the government, so it won't likely be till 2025 or something, an instantaneous system. We've been asking about this. We've been wanting something like this for years and years and years. The technology has been there to do it, but only now when there's some sort of competitor do they decide to create a real-time payment system, which of course is a competitor to all of crypto and DeFi. And this says agencies will encourage the adoption of the instant payment system, of course, so that you don't go outside of the system that the government created for you. And again, I say all of this with a bent towards not being a big fan of this particular framework. And the reason I'm not a big fan of it is because it is the government trying to put their foot down and kind of go against all the innovation that is already happening and is continuing to happen. So why they say they want to foster innovation, in reality, what this framework says is we really don't want all this innovation. We appreciate the fact that you all crypto people are getting everyone wanting instant payments. You get everyone wanting more transparency. So we're going to create a framework that tells everyone they need instant payments and transparency, but you're going to do it on our terms. They obviously want to have create a federal framework to regulate non-bank payment providers. That seems relatively interesting and acceptable, I guess. Then we move down here. Oh, real quick. something that stuck out. Some digital assets could help facilitate faster payments. We know this, or make financial services more accessible. That's exactly the whole point. But more work is needed to ensure they truly benefit underserved consumers and do not lead to predatory financial practices. Okay, right here are the underserved consumers that are relying right now on predatory financial practices. So this already exists in the traditional world. You already have customers not being served and their predatory financial practices. And so now the government is saying, well, we don't want that again. So in the absence, so while we're investigating, while we're looking into this and trying to figure out what we're going to do, keep using those predatory financial practices. It doesn't make sense. The system is here. So let us go use it and help people understand it. If we're going to move forward here, let's see, agencies will encourage the adoption of instant payment services. Again, that's exactly what DeFi is. So that's really nice. This here, let's see, I apologize, I made some notes. Stablecoins in particular could create disruptive runs if not paired with appropriate regulation. I'm not sure where this regulation is going to come from. Digital assets, obviously we've talked about stablecoins quite a bit. They're extremely important for this ecosystem. They're extremely important for you, for your clients to understand. And they do probably need a bit of appropriate regulation. The question is this government, is this administration, is Congress, are these the right people to actually regulate it? Because they've shown to this point, they really don't understand the technology nor the need and are stuck in the 1930s. And so are they the appropriate people to regulate? Should stablecoins, because of their international nature, be regulated and governed by the industry? Should there be a stablecoin industry, a stablecoin association that creates their own self-regulate? Should it be a self-regulatory organization? That's kind of what I think, that we should all, those of us in crypto should kind of create our own regulation and governance and hold ourselves to it, because we know that if we don't do that, then governments are going to start stepping in. So I will say this for the crypto and DeFi people. As long as we continue to create, whether it's applications, protocols, dApps, whatever they might be, that are trying to do nothing but create yields that are not really accessible, then there's going to be more and more regulation. We need to make things we need to create protocols, applications that actually make financial sense for people, not just trying to earn as much money as you can, because you're going to have a lot of people jumping in, and then they're not going to be safe. They're going to lose their money. So if we keep stepping through here, the Treasury and financial regulators are encouraged to, as appropriate, provide U.S. firms with regulatory guidance. It's kind of what we've been waiting for, but instead of regulatory guidance, we are getting nothing but enforcement actions and absolutely no guidance at all. Not from any government organization that is trying to regulate crypto. There has been almost no guidance, and it seems like a whole bunch of infighting and trying to figure out who is going to regulate. And other than that, this entire framework is nothing but setting out, here are all the different parts of the government that we want to have their little piece of this, and do nothing but bloat the government a little bit more, which is kind of the whole purpose of crypto, is to get around these bloated governments that cost us a whole lot of money. So with that, I'll kind of, let's see, move forward here about, let's see. There's a big push on fighting illicit finance. That's things like money laundering, that's things like terrorist money, drug money, cartel money, all of that through moving it through crypto. There are definitely ways to do this. This seems like with what we saw with Tornado Cash a couple months ago, and what we're seeing here, the verbiage that's in here, it seems a whole lot like this, the tail wagging the dog. We're so concerned with illicit finance, we're missing the point that we pointed out earlier, which is the 7 million underbanked people, the 24 million people who are using check cashing services. The system can be great for them, And we can't let the potential negatives outweigh the positives that can be brought here, but it seems like that is what the government is looking to do here, is let all the potential negatives outweigh the positives. So I highly recommend everyone go read this. And of course, I think about it with a very bent eye. Anyway, so let's move on to bigger and better and more fun things. NASDAQ entered the crypto business, focus on security. NASDAQ is going to custody Bitcoin and Ethereum for institutional clients. This is a big deal. This is a traditional power, a traditional market power that's going to custody crypto assets. This is after the week before we found out that Schwab, Fidelity, Citadel, Virtu, Sequoia Capital, Paradigm are all going to create a crypto exchange, and now we have NASDAQ custodying crypto assets. This is a big deal. This is more traditional folks saying this is real. This is not going away. So again, if you are in crypto, if you're in financial services and you're kind of on the fence, I don't know what else. I don't know what else you have to learn to get you to start, or what else you have to see to get you to start learning. If NASDAQ, Schwab, Fidelity are in, of course, we know that BNY Mellon is custodying. We know that Northern Trust is custodying. All these, they've done their research and they've said that this is viable for us. We need to be a part of it. This is going to be important enough that we're going to custody these assets. If you're a financial advisor, you better start learning about this. You better get over yourself if you think that crypto is not going to make it. All these companies are not pouring money and time and everything into this for it not to make it. So now we'll move forward. This is a big deal when we start speaking of governance again. California had a bill proposed and sent to the governor that would have made it to where stable coins have to be issued, can only be issued by a bank if they're going to be used in the state of California. Ironically, it was the governor's own executive order that led to this. But then the governor went and vetoed it. This is actually in my opinion, a really good move. This would have really hurt California. It would have not allowed them to be on par or on board with the rest of the country when it comes to digital assets. So Gavin Newsom, the governor, said, we're going to wait for regulation and guidance from the federal government here, which, in my opinion, is probably the right move. It's important for any financial advisors, especially those of you that might be in California, that now you know that there's not going to be a problem with stable coins or with crypto in California for the time being, and it's not going to be any different from what's happening with with federal regulations. So now we'll look, excuse me, for a kind of on the negative side of regulation. Again, it seems like this week is all about regulation. Legal experts, the CFTC sued a DAO, basically saying all the members of a DAO are legally liable and financially liable for what happens in that DAO. This is a big change, one, because the CFTC, this is basically regulation by enforcement, and the CFTC was the one who called out the SEC for doing this, and then the CFTC goes and does the same thing, and this is arguably the worst enforcement action that has happened at all towards crypto. This is a big deal because it means that anyone who owns a token for a DAO theoretically could be financially liable. Now, that doesn't mean that just because they sued the DAO doesn't mean that they'll win. They'll probably be arguing, likely that the DAO could win. As a matter of fact, one of the commissioners of the CFTC had a scathing response to this. He did not like this at all. He said, this is not how we should do things. We should provide guidance. We should not be governing by enforcement action. And I am not on board with this. So that was actually pretty nice to see. And this was a gentleman, Summer Mersinger, that again was a Republican, however, was appointed by Joe Biden to the CFTC, and is basically saying we will be stifling innovation if we allow all the members of a DAO to be held financially and legally liable. So that was very helpful in terms of his dissent. But remember, it's still a dissent, meaning they actually sued. So a reminder that this doesn't mean that this is precedent. It means that it's precedent only only after there's some sort of settlement, only after there's some sort of decision as to whether the CFTC wins this suit or the DAO members win this suit. That's what will set the precedent. So other than that, from a financial advisor perspective, I was actually in New York last week for mainnet, for Messari's mainnet, where Messari themselves announced they had raised $35 million more, which is a big deal because Messari provides great data and analytics and research around the crypto and DeFi world, and they're going to be offering that even more. I talked to so many people in traditional finance, of course, in New York, which is the hub of traditional finance, that were at that conference learning about it. People from funds, people who are investment advisors, people from large broker dealers that were there and interested in learning. So we didn't, the markets went down, the crypto markets went down with everything else. The other big news, of course, the Fed raising rates 75 basis points, which we all knew was going to happen. We've all been talking about how inflation was coming. Oddly enough, everyone, I think most people who were involved in crypto for the last several years had I feel like had a much better idea that one, inflation was going to come, and two, that the Fed was going to have to start raising rates and wasn't quite sure how to handle this for a couple of years. And I felt like I was more prepared and understood that more because of my studying of the crypto world, because that got me down the road of understanding how the traditional finance system works much better. But of course, prices dropped considerably. Prices of Bitcoin, of course, dropped considerably. If we, go look at a chart, well, I say considerably, like they dropped. They've been hovering around this level. I'm not a big chart guy anymore, so I'm not sure where we go from here. But know that it's been banging down at this $19,000 number for quite a while. So you wonder if at some point it just breaks and we see Bitcoin move down, which will likely drag everything else down with it. So that is the update for the week of, I guess, whatever, last September 19th, which was last week. All the updates from all the news last week. Again, hope you enjoyed this. Hope you enjoy the Interaxis weekly crypto update for financial professionals. I hope you'll go take one of our courses if you're interested, be a certified digital asset advisor. We have more news around CDAA and planar DAO soon. So visit us, interaxis.io, see if you want to take a course, learn a little bit more about crypto. Hope you enjoyed this weekly update, Crypto for Financial Advisors, and we will talk to you next week.